So till now we have seen yield curves. What is an yield curve? Interest rates, how they move, why they move, and what are the different shapes of yield curve. Now, as we said in the earlier video, till the time we don't know how to apply all of this, this is of no use to us. So before we get into applying the yield curve data, we need to go deeper into a point which we had earlier discussed in one of the videos, but we had made a fleeting reference where we had said that bond prices and interest rates move inversely. That means when interest rates go down, bond prices go up and vice versa. First, in this video we will just try to see that math. Why? Because we have to apply that. So till the time we don't know it, we can't appreciate it that much. So let's quickly create a small bond structure. Let's say, for example, there is a bond with a face value 100. There is a bond whose coupon is, let's say, 8%. When a bond is being issued at a coupon of 8%, it is safe to assume that YTM also must be 8%. Let me explain this in detail. Why? Because if the market scenario is 8%, an investor would obviously like a 9% bond because he wants to earn higher income, and a borrower would obviously like a 7% coupon because he would like to pay less interest. So the golden level at which both the borrower and the investor will be happy will be the prevailing market rate. So therefore we are saying that when the interest rate, when the coupon is 8%, the coupon of 8% will happen only when the market interest rates are close to that level. And let's say this is a bond with a term of 3 years. So how will the cash flow look like? So let's say 0, 1, 2 and 3. We are trying to very simply just understand one point, because in real life interest rates or coupons, they are paid semi-annually by the government. There are other issues. So we are not going into the micro operational things. What we are trying to do is just try to appreciate one concept. So what will happen is, on day 1 we will have to buy the bond, and therefore we are saying minus 100 on day 0. Why minus? Because money is going out of my pocket. Why 100? Because the bond is being issued at face value, let's say 100. So on day 0 I am giving 100 rupees. What will happen after 1 year? I will get, let's pay attention, I will get 8%. Now the coupon, the cell which is selected is the coupon 8%, not the YTM 8%. What I will get is the coupon 8%, and 8% of what? 8% of the face value. So after 1 year I will get 8 rupees as coupon. After 2 years I will get another 8 rupees as coupon, and after 3 years I will get my 100 rupees back. That's the principal, of course, and another 8 rupees. So these are the 3 different cash flows. Many times we make a mistake of saying that this bond has given me 24 rupees, and that's a very wrong statement to make in finance, because the 8 and 8 rupees are being received after 1, 2 and 3 years, and there's time value to money. So we simply just can't add 8 and 8 and say this is a bond which is giving me 24 rupees. So how do we add, or what is the treatment that needs to be done, or why was this bond issued at 100 rupees? We all know that there is something known as compounding, where we say amount is equal to principal into 1 plus r raised to the power n. Now we want to do something known as discounting. So discounting will be, we have to find out the principal. So P is equal to A divided by, this is basic mathematics, 1 plus r raised to the power n. So we are doing discounting. So discounting is nothing but finding present value of a future cash flow. So what we want to know is, if after 1 year I will be receiving 8 rupees, how much should I invest today? So we have to find the present value of the future cash flow. What is the future cash flow? 8 rupees. When is it coming? After 1 year. At what rate my money will be growing? At what rate my money will be growing? We are focusing on the now YTM wala 8%. This is not the coupon 8%. Let us quickly write down. Fixed doesn't move. Variable, this will keep moving. That's the risk in bonds. That's the risk in bonds. There are bonds which are known as floating rate bonds, but that's later at a very basic level. So P divided by bracket open 1 plus 8% bracket close raised to the power 1 year. So we get 7.40. So how do we read this 7.40? For one, what it means is, if I invest how much? 7.41 rupees. For what period of time? For 1 year. At what rate? At 8%. Then how much will I get? I will get 8 rupees. Quickly, if I invest 7 rupees 41 paise for a period of 1 year at the rate of 8%, I will get 8 rupees after 1 year. Now the same thing we need to do for the other two cash flows. Is equal to 8 divided by 1 plus, we are doing the YTM, 8 raised to the power, now it will be raised to the power 2, is equal to 108 divided by 1 plus 8% raised to the power, now it will be 3. So these are the future cash flows. And now if you add all of these, if you add all these 3, we get the same 100 rupees which we have paid. So let us understand that when the investor is paying 100 rupees, he is essentially paying 7 rupees 41 paise for the first 8 rupees. He is paying 6 rupees 86 paise for the second cash flow, and he is paying 85 rupees for the third cash flow, and add all of them. So he is giving 100 rupees. We can understand this. A simple example will be of, let's say, housing loan, where we get one lump sum and we pay back slowly in EMIs. Here what is happening? We are giving one lump sum and we will get it back slowly as coupon, and so that's what it is. Now the part here is, pay attention, if interest rates go up, 8% becomes 9%. Look at what happened to the price of the bond. The bond price goes up, goes down, 100 becomes 97. Again, if interest rates 8%, if interest rates go from 8% to 9, interest rates go up, bond prices come down. Interest rates go down, bond prices go up. So there's an inverse relation. What is that inverse relation? Bond prices are inversely proportional to interest rates. When interest rates go up, bond prices come down, and vice versa. This is extremely important in understanding what we are going to asset allocation. This also explains what we had seen when the yield curves are high and when the 5-year paper, the yield had come down. Why it had come down? Because everybody was buying that paper. So when everybody buys something, the price go up. When the price goes up, the yield comes down. When everybody sells something, the price goes down. When the price goes down, the yield goes up. So that's what we have just now seen here. So now let's go forward from here. Having understood this, from this chart we move to the next chart, and let us first see what this chart is all about. This chart is from 2001 till 2011. This chart shows repo, reverse repo, CRR, MSF and Nifty. So index or maybe Sensex, whatever. Now let us try to see the first part. What is happening is, from 2001 till 2003, that means for a period of, let's say, April to 2001 to 2002, 2002 to 2002 full years. For 2 full years, what was happening to the interest rates? You can see the repo rate came down from as high as 9%. It came down, and it came to what level? This was close to 6%. Parallelly, the repo, the reverse repo and the CRR also came down. What was the CRR? The green line. CRR was close to 5%, very low, very low for a long period of time. We didn't see this low CRR. Now, let us see what happened to equity markets. Look at Nifty during that period of time. When the interest rates were high and when they were on their journey down, the equity index was going nowhere. The equity index on the right hand scale, it was going nowhere. What it means? What it means? If interest rates are high, and when did the index start moving? The index started moving after, this is very important, the index started moving after the interest rates had bottomed out. Which means when interest rates are right at the top and when they are yet to come down fully, even if you and me as an investor, we remain invested in the equity as an asset class, we are not going to generate any great returns. And we have seen just now that when interest rates come down, the price of bond keeps going up and up. So which brings us to a very important conclusion, that being in the right asset class at the right time makes a big difference to our returns. Because what happened during this same period, while equity as an asset class did not move at all, during this same period when interest rates came down, that translated into bonds, and specifically long term bonds delivering excellent returns. So what needs to be understood is that as an investor, before we take an investment decision, we must first have an idea of whether that asset class as a whole is poised to deliver or not. If interest rates come down, all bonds go up, and within that the bonds with longer term or longer duration, they will go up more. So therefore this was the period from 2001 to 2003. If you and me as an investor, had we invested in long term bonds for this entire period, we would have made a lot of money. Had we stayed invested in equity for this period of time, we would not have got any returns. So that is how these interest rates and bond prices are important. Now this is the logical part. What does Indian data show? Now this is the sad part, the truth, bitter truth, and the sad part. What does Indian data show? Indian data shows that you and me, the retail investor, when did we enter bond markets? We entered bond markets here. Why did we enter here? Because we are in the habit of looking at past data. So a typical investor asks a question, has this particular mutual fund scheme delivered good returns in the past? So a long term bond fund will deliver great returns here. Why? Because the interest rates have fallen. Now this point, when interest rates are at their lowest, it also means bond prices are at their highest, and which means you and I should not be buying those bonds, you and I should be actually selling those bonds. But sadly, Indian data shows we, the retail Indian investor, we exited from equities, because for a long time equities did not do anything, and prior to 2000 index was at 6,000, like Sensex or Nifty were at high, the Y2K bubble burst. So people had invested at the high level of index, they waited in that high level of index, they saw their money coming down, they made huge losses. All the time they were sitting in equities, they as in you and me, all of us, we were into equities and we saw bond prices going up and our money going down. So right at this time what we did, we booked our losses in equities, took whatever money we had and entered bonds. When the interest rates were low, we entered bonds. Now what happened after that? As the interest rates were low, we have seen that when the yield curve is normal or steep, economy starts chugging along. So when the economy started chugging along, we can see the Nifty or the Sensex, we know the famous journey of the Sensex from 3000 to 21,000. 7x Nifty Sensex went up. Nifty, every stock went up during that time. It was a crazy bull run. But where were you and me? We were into bonds. Why? Because equity markets are risky. Now what happened with our money? We were into bonds and we saw equity markets going up, and parallelly interest rates were also rising. So because of that, our money, which we had already lost earlier and that had come down, now that was also losing because the interest rates were losing, interest rates were going up. So we were losing money again in the bond market. When did the retail Indian investor enter equity markets? Indian data shows, sadly, we thought this was a good time to enter. Sensex 15,000, Sensex 16,000, Sensex 17,000. So what did we do? We lost a lot of money in the bond markets for 3 years, 4 years. Then we said, no, this asset class is not good. We should be going into equities because that asset class is going up. And so we bought at 16,000, we bought at 17,000, we sold our gold and bought at 18,000. We sold our, we took money out of fixed deposits and entered at 19,000. We removed money out of PPF and entered at 20,000 and 21,000. And then when the interest rates were right at the top, the equity markets crashed. Because if you remember, during this time, April 2008, this was the period when we saw here, had we known the knowledge of yield curves, this was our June and July 2008. June and July 2008. What was happening? The yield curve had moved from flat to high to inverted, which means bad times are coming from the economy. If the economy is going into a tough time, how can equity markets perform? Because if GDP is not rising, where will earnings grow? So fundamentally we were going down. But what was happening to the stock market prices? Pay attention to these dates: April 2007, April 2008, April 2009. During the same period, the equity market kept going up, up, up. Interest rates were right at the top. But for some strange reason, we were investing big time into equities. We lost the money there. Then it again, and the cycle continues. The retail Indian investor, for lack of knowledge of these small simple things, always ends up on the losing side. What needs to be done? It's a very simple cycle. It's a very simple cycle. What do we do? When interest rates are high, get into long-term bonds. When interest rates are high, get into long-term bonds. For how long? As long as the rates come down. When interest rates have reached their bottom, whether it's here or whether it's here, anytime the mathematics remains the same. When interest rates have reached their bottom, take your profits out of long-term bonds, and then equity becomes the obvious and the logical and the natural asset class, because when interest rates are low, the economy is going to go up. If the economy is going to go up, company sales will increase, so profits will increase, so EPS will increase, so stock price will increase. If the rates are low, money will flow into the economy, so liquidity will find its way into the stock market and the prices will go up. It's all so natural, it's all so logical. So when the interest rates are low, we enter equity markets. How long? As long as the interest rates keep rising. There comes a time when interest rates have reached very high. If you have entered at 3,000 Sensex and if you have made 5x money, 15,000, you should be happy, because that's the time when we should be exiting, because interest rates are no more as low as they were. So we come out, and where do we go? The third asset class, short-term bonds. We saw the flat yield curve. We saw the flat yield curve. So till the time interest rates don't peak, till the time the interest rates don't peak, we exit out of equities and we remain into short-term bonds. For how long? Till the time the interest rates don't peak. When the interest rates are at their peak, we again take money out of short-term bonds, move into long-term bonds. For how long? Again the rate comes down, we make money in that, and we enter equities, again the rates go up. It's as simple as that. This can be proved with just 2 data points or 2 dates. What were the valuations? What was Nifty PE? April 2003. What was the interest rate? Let's quickly see. April 2003 is this period. April 2003 is this period when interest rates are at their lowest. When interest rates are at their lowest, what was the Nifty PE on that date? Nifty PE was, or what was the Nifty PE was, this was the day when the valuations were lowest. Look at the yield curve. Look at the yield curve. Nice normal yield curve which any equity investor would find mouth-watering. Short term 4%, long term 6%. You have got nice 2.5% range. So a normal yield curve, low Nifty valuations. All you need to do is just walk into the equity markets. Look at 2007. 2007 equity markets at their lifetime highs. What was the yield curve telling you? Inverted. What were the levels? 8%, 9%, 10%. What were we doing in the equity markets? This was the time to enter long-term bonds. Time after time, cycle after cycle, there is data in the Indian markets to show. March 2009, after the crash, after the big crash of 2000, everybody was afraid. Why should I go into the equity markets? What were the valuations? The valuations were low, and look at the yield curve. So if we invest based on emotions, we will make losses. If we invest based on knowledge, probability of making profits will be slightly higher. A simple topic, nothing difficult, and that's about it. So yield curves and interest rates are very interesting, very important. RBI keeps telling us what the direction it's giving to the economy. Keep an eye on inflation, keep an eye on the language. We can manage our, even as retail investors, we can manage our risk fairly well. Thank you so much for watching. Thank you NIFM for giving me this opportunity to make this presentation. Thank you so much.